Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is accounting for a profitable long-term contract. This is a special topic about revenue recognition. And long-term contract, we have uh, three scenarios here. Profitable long-term contract, profitable but with some partial losses in some periods, or entire loss in long-term contract. So we have three videos about that. The other two videos, they are in our video description. Okay, so the 5 steps to revenue recognition: identify the contract, no problem here. Number two, the performance obligation. Here we have single performance obligation. Long-term contract, for instance, construction. Uh, we are constructing some building and we need to deliver this building. Transaction price, no problem at all. Allocate the transaction price. That is no problem here. We have only one performance obligation. However, the last one, recognize revenue when each performance obligation is satisfied. And then we have at a point in time and over a period of time. So step 2 and 5 are critical. Step 2, usually single, and here step 5, we recognize it toward completion or upon contract completion. Okay, so let's go to our Excel file. And here we have data for profit, partial loss, entire loss. So we have the data for all of our three videos here. So let's consider we are constructing an office building. And the contract price is $12.5 million. And it will be done in 3 years. So let's consider here 2018, 19, and 2020. And we have these costs here incurred the year. 3,750,000 first year, 2.5 million second year, 4 million the third year. And here incurred in prior years. And we have the cumulative costs here. And okay, we are here at the end of 2018. We have the estimating remaining cost to complete. So, okay, what is the remaining cost that we think we will have it? First year, $5.6 million. So the total cost, 9.3, lower than the contract price, 12.5. So we have a profitable contract. Second year, total cost 10, contract price 12.5. You still have a profitable contract. Third year 10.2, contract price 12.5, profitable contract. So we have here profitable contract. And this one here is our billing. So it's our cash flow here. 3 million first year, 5 million second, 4.5 million third. However, this is not our revenue. This is our cash or accounts receivable or notes receivable. We need to find the revenue here. However, let's do the first one. That is contract completion. So, okay, we will recognize our revenue only at the end of our contract. So, how do we do that? Uh, So let's delete it here, delete it there, delete it here. So first of all, construction in progress. That is our costs. 3.7 first year, 2.5 second, 4 million third year. And the credit here is cash or accounts payable or notes payable or any other payable. This is our costs. However, this is not an expense. This is our asset. We are building an asset and then this asset will be So this is just like an inventory. And then we have the billings. So debit, cash, credit, our billings. 3 million here, 5 million there, 4.5 million here. Okay, and this one is just like deferred revenue. We are receiving it in advance. However, we don't have asset and liability. We combine both. So 2018, 3.7 asset, 3 million liability. So this billing in contract will be a contract account of the construction in progress. So we will have an asset here, $750,000. Second year, here we sum it, we will have 6 million in a quarter. We sum here, we will have 8 million. So now, construction in progress will be a contract out of billings on construction contract, and we will have a liability, just like a deferred revenue. However, okay, we are in 2020. We have the revenue. So how much the revenue? The revenue is our contract price. This is our revenue. How much is the cost of goods sold or the cost of construction? The cost of construction will be the sum of our costs here, or simply the total costs here. So let's do equal the total costs here. However, man, it's not balanced. We have debit at 10.2, credit 12.5. We need some debit to balance it. Debit to balance this journal entry will be construction in progress, will be our inventory. So our construction in progress here, 12.5 less 10.2, it will be 2,250,000. Now, what is our problem? We have 12.5 million on asset, 12.5 million on liability. These numbers must match all the time. However, we don't have the building anymore, and we don't have the deferred revenue anymore. So we have here a journal entry for closing. So we sum here, we sum our debits here, we close it, and the debit will be the same number to match our journal entry. Now, this construction in progress is closed, billings is closed. And we have only revenue and the cost of construction. However, this is not a good model because we don't have partial revenues and partial costs. We have only one revenue at the end of our long-term contract. But okay, let's do it toward completion. Let's delete these guys here. Let's delete these guys here and here and there. So let's do it. If we are going toward completion, we need revenue and costs toward completion. The costs, they are, and also revenue, they are not so hard. What do we have here? Let's just come back here. Uh, sorry. So first of all, the cost of construction will be the cost incurred each year. So let's come here. Construction in progress, it will be 3.7 2018, 2.5 2019, 4 million 2020. Billings, the same. Billings, $3 million. Whoop. $5 million and $4.5 million. $4.5 million here. Exactly the same as the first example here. Our credit will be here cash or anything payable. Here, debit cash or anything receivable. The cost of construction. So the cost of construction will be the same as construction in progress. This is our cost. So no problem. The problem is our revenue. The revenue is not our billings. This is the period revenue. How do we find our revenue? We find based on percentage of completion. So let's do it here. So how do we find the percentage of completion? The actual costs, that is our cost in 2018, divided by total cost. That's why we need this estimating remaining cost. So 9.3. 3.7 divided by 9.3. 3.7 divided by 9.3, 40%. So 40% of our costs, they are done in the first year. That's why the cost is also this number here. And so 40% of our revenue must be recognized on the first year. How do we find it? Contract price times 40%. We don't have prior years because this is the first year. So this $5 million will be our revenue. Revenue here, $5 million. However, okay, this number is cash. This number is cash. So our journal entry is this number here. It is not balanced. So we use the same approach here. Revenue, costs, the number to balance is construction in progress. Revenue, costs, the number to balance is construction in progress. So 5 million less 3 million and 3 quarters. $1.2 million or 1 million and a quarter. This is our gross profit. So this is our gross profit for 2018. What about 2019? 2019 a little bit different because we work with cumulative numbers. This actual cost is 2.5 plus 3.7, $6.2 million, or the $6.2 million here. That is our cost combined. Our total cost now is 10. So the formula is the same. It is 6.2 divided by 10. Third year, the same. Our total costs, oops, our actual total costs divided by total costs. And here, last year, will always be 100% because our long-term contract is finished. Our building is done. So, okay, at the end of the second year, we have 62.5% of our building done. So we have the cumulative revenue, 12.5 times 62. So this is my cumulative revenue, 2018 plus 2019. And we subtract the beginning balance, that is our $5 million. So the revenue in the current period is 2.8. Then the first question is, oh, Professor, we can also do it on this one. And, until the end of 2019, we have 62%. Until the end of the first year, we have 40. So the second year, we build 22.5. So if we go here, 12.5 times 22, we have the same number. Can we do it? Yes, no problem. Okay? So here, this is our revenue. This is our revenue, 2.8. And the same, the cost of construction, 2.5. So we are profitable here. So the gross profit is 2.8 less 2.5, 312. And it will be profitable because we always compare these numbers here. Okay, and then the contract price must be greater than the total cost. Third year, we do the same. So we have here 4.6. And our revenue, 4.6. And then the gross profit will be 4.6 less 4. It will be 687. And then we already have our numbers matching because we are recognizing gross profit over the 3 years. So we only need to close it. So sum here and the same number here. We have it closed. Gross profit total 2.2. Let's green it. The gross profit here 2.2. The same number as the construction in progress. So we can do the formula here. Gross profit. Gross profit, it will be revenue less the cost of construction. Also 2 million and a quarter here. Of course, they will be the same. They must be the same because this is the same contract. We are only splitting this number in 3 years. So the total will always match. Okay, guys, so thank you so much. This is one of the hardest topic on revenue recognition, guys. So you can watch this video how many times you want. And by the way, subscribe our channel. You will be the first one to know when a new video arrives. If you have questions or comments, leave it here or email me at jscarping@gmail.com. Like our Facebook page, Accounting Hub by Dr. Scarping. Have a very nice day and God bless you.